Thank you, Sean, and welcome everybody. I want to thank Sean and his team for inviting me back again this year. As you can imagine, as an economist, it's not often we get invited anywhere. So when we do get invited back, we're very appreciative. Since last year, a few things have changed, a few things haven't changed. The Leafs are still in last. We've got this big rebuilding project going on, so quite hopeful. Spent a lot of money on a lot of talent. Those talent, unfortunately, wear suits rather than skates, but down the road, we should see something. I had an email from a colleague in Edmonton, and Edmonton, remember, is the team we're fighting for last place. The email was that during the rebranding of the Leafs, they wanted to, the suggestion was to put a new logo on, and the new logo was a possum. They sleep at home and get killed on the road. So that, I thought that was a bit harsh. In terms of the economic outlook, I'm going to give a broad overview of how we see the economy unfolding as we move forward, and touch on some of the topics the minister touched on it with respect to Ontario. Our view this year, as it was last year and probably the year before that, it is an uncertain and uneven and somewhat underwhelming recovery, so not particularly upbeat. We're a little bit higher than consensus for Canada and indeed for Ontario. So for Canada, just a notch above the consensus. We're including some fiscal stimulus, which I'll touch on. But it is still very modest growth, and that's consistent with this underwhelming. The speed limit for Canada is lower, so anything above that 1.5% or 2% growth rate now should be viewed as a good news story, because labor force growth is slowing, the aging demographics kicking in, and productivity is also very weak. So as we move forward, a slower growth profile is likely in the cards. So that sort of we have to manage our expectations down to that. Obviously, in a lower growth environment also comes with lower interest rates. So a number of components to that view. The uncertainty we're seeing on a daily basis, we're seeing movements in financial markets. It used to be a big move for a quarter or a year, and this is taking place almost on a daily basis. And I think right now we're probably seeing a bit of this fear overtaking fundamentals. At the end of the day, we think fundamentals will carry the day and growth will move forward. But unfortunately, the longer the fear persists, the more likely it is to become a fundamental. And in the interim, it's holding down growth prospects, holding investments slower than would otherwise be, and also holding employment a little bit softer. The uneven nature we're seeing around the globe within countries and within regions, and Canada's a perfect example. Our growth leaders of the past, in Alberta, for example, one of the growth leaders is now moving down to the bottom of the growth tables, and the flip side of that is we're seeing pickup in those export-dependent provinces, Ontario being one of them, and British Columbia we have at the top. So it'll be a bit of a bumpy ride as we move forward, but we do think growth prospects will improve. In terms of the uncertainty, there's a number of different indicators you can look at. You can look through the bond market, the equity market, currency markets. This is the volatility index people refer to as the fear gauge. It's based off equity market performance, and you see these big movements. This is the level terms, but if you look on a year-over-year basis, last August when China moved on their currency, a modest 3% depreciation of the currency, on a year-over-year basis, this fear gauge spiked by 250 percentage points. At the weakest point during the 08-09 crisis, that volatility index spiked by 300 basis points. So still very elevated level of uncertainty. When you look at the risk, it's the big challenge, I think, for policymakers is that the risk narrative is changing. So it's sort of a crisis extrapolation. Everybody missed the last crisis, so nobody's going to miss the next one. So every little wiggle in the data is the next crisis that's coming. See worries about China, emerging markets, commodity prices, Eurozone, European banks. The UK, will they stay or will they go within the context of the European Union? The U.S. Fed, the central bank there, moving rates higher, other central banks moving rates lower, or indeed some into negative territory. And then the possibility of a Trump victory is in there. There's a lot of uncertainty in there, and some probably more warranted than others. In terms of China, I'm not as worried as some would suggest. If we look at the Chinese economy, we had some pretty weak trade numbers today. But I think generally what you're looking at is the economy is slowing. It is slowing because aging population, demographic challenge is arguably more acute than what we're facing, and the low-hanging fruit on productivity has been picked off. So we're seeing a continued slowing trend. Policy is also aiming to slow growth to more sustainable speed. So over the next 5 years, the plan is 6.5%. This year, the plan is somewhere between 6.5% and 7% growth. if you look at alongside of this slowing growth profile, policymakers are also trying to rebalance it. So away from exports and investment, more towards the consumer and retail spending more generally, service sector lift. And what you're seeing is that rebalance is taking place. Growth is slowing down. And when you look at what options are available, if growth falters, the authorities have shown every willingness to use all the policy tools available. They can move on the exchange rate, they can move on interest rates, reserve requirements, or fiscal stimulus. So they'll manage growth to the speed limit they want. They're aiming something in around 6.5%. We think they'll get pretty close to that. On the oil price outlook for Canada, obviously near and dear to our hearts, historically, what you see for oil prices, the best cure for low oil prices is low oil prices. You get a demand and a supply response. The demand is low oil prices kick in. Effectively, it's a tax cut for consumers and businesses, so more money left in the pockets rather than put in the tank. And that eventually picks up demand. So a few countries around the globe export oil, but all countries use the import component, and that effectively is a tax cut. So global growth should get a bit of a lift as these energy prices remain fairly soft. Supply side, usually lower prices. You see supply get cut back. And I think that's where the big surprise has been in the current environment, is the resiliency of the U.S. shale play. So notwithstanding lower prices, we continue to see production, until recently, continued to move fairly strongly. Now we're starting to see that shale production roll over. But the big wild card is what's going on with OPEC and non-OPEC. So an already excess supplied market, oversupplying this already excess supplied market, and that's keeping the prices very weak. As we go forward, we do think we'll see some modest rise in oil prices. We have this year an average of $40. Today it's just under 40. And then next year, we think it'll pick up to about just over $55. So a modest improvement in oil prices as we move forward. Any point estimate on oil, though, you have to put an abnormally wide range of uncertainty around it. We are seeing very much the politics of oil rather than the economics of oil driving things these days. On the interest rate side, there's concern about the so-called exit strategy, so which central banks are moving when, and they're all going in different directions, and that's contributing some of the volatility. When you look at the interest rate environment, we've never seen so many central banks so accommodative for such a long period of time, so by definition, we've never seen a successful exit from this period of accommodation. Governor Carney, formerly the Bank of Canada governor, now the governor of the Bank of England, he had his team look into the last time we saw interest rates globally at these low levels, and they did a bit of digging, and they found out the last time we saw rates at these low levels was in 3000 BC, so it was some time ago. So it is an abnormally low period for rates. We're seeing moves going. The Fed, the U.S. Central Bank, started to raise rates back in December. We think that trend will be continuing as we move forward. Other central banks have moved into negative territory, and this week we expect the ECB to go even further into negative territory. So you're getting a divergent monetary policy, and that's contributing to continued uncertainty as we go forward. In terms of global growth, it's a good news, bad news story. If you look at the IMF global growth forecast, the good news is the forecast is expected to pick up next year to that 3.5% range. The bad news is that they expected that this year and it didn't happen. So we continue to see this sort of delayed recovery. Last year set the lowest growth since the 2009 crisis. The thinking now is with monetary policy very accommodative with this effective tax cut from oil prices and fiscal policy in some countries supporting growth and other countries at least not weighing on growth. We should see this global growth recovery take hold, should help commodities and should also help global trade flows. The U.S., this is sort of one of the more optimistic views, I think, of our overall growth story as U.S. economy. We do think it's starting to get some self-generation going on. We will see growth continue to pick up. A lot of it's driven by what we're seeing on the employment side. We get asked if this has a Trump victory or Hillary Clinton victory. We don't put politics in until we see the actual outcome. I have watched some of the leadership debates, and it does make reality TV look educational. So it is something to keep your eye on as you go forward. But until they get in power and then they do present their policies, and if you follow Trump, we're not sure which policies he has. But as we go forward, it is something to keep an eye on. But near term, it does look like growth is picking up. It's led by the consumer side. And a little more broadly based than that, if you look at all the components of growth, most of them are adding to growth in the U.S. economy. The exception is the trade side, soft global economy, very strong U.S. dollar. That's weighing on the trade side. But the other sectors we think are adding a bit to growth as we go forward. U.S. consumers still about 2/3 of the U.S. economy, so as long as they have jobs, they'll continue to spend. And the job story in the U.S. has been fairly strong. If you look at the last couple of years, just over 250,000 jobs each and every month on average. This year, we expect that trend to soften somewhat, but it's still a very strong employment market. So with the consumer, as they have jobs, they have income, some of that goes towards savings, debt reduction, some of it goes towards spending. Continue to see that unemployment rate moving lower. We're looking at an unemployment rate right now at 4.9. We expect that trend to continue to move down as we go forward. And we're starting to see some early signs of wage pressures building in the U.S. economy, which is what the U.S. central bank's looking at. So for a rate story in the U.S., very slow, but a gradual increase in interest rates. The Chair Yellen has made it very clear it's a conditional and cautious tightening cycle, so it's going to be very much data dependent. If we're right, growth continues to build as we move through the year, we should see modest interest rate increases going forward. We have 3 further moves by the end of this year, so that gets overnight rates up to 125. A long way off of what we would think is normal, but still a rising rate environment. Part of that story, I think, has been reflected in the U.S. dollar. So we look at the Canadian dollar. The flip side of what we're seeing in some sense has been U.S. dollar strength rather than Canadian dollar weakness. There's some Canadian factors behind it as well, but overall the U.S. dollar has moved higher relative to most currencies. It's shot remarkably higher, so I do think we'll see a bit of a leveling out here. But as growth looks stronger in the U.S., as interest rates move up in the U.S., we should see that U.S. dollar remain fairly firm on a go-forward basis. For the Canadian dollar, so if you look at the period when we saw the Canadian dollar move north of parity, there were a number of factors underlying that. We saw a fairly steady downward trend in the U.S. dollar from about 2010 to 2012 or 13. So the flip side of that was Canadian dollar strength. Commodity prices, obviously very tightly tied to the Canadian dollar. What we produce, the price and demand for commodities go up, so too does our currency. So we saw some of that play kick in. And then we also saw some portfolio flows favoring Canada relative to some other countries. So those were in the past the positives. Now, if you look at those factors now, we're seeing U.S. dollar strength, flip side of that Canadian dollar weakness. Commodity prices, everyone's well aware of what we've seen in commodity price space, but softer commodity prices comes with it a softer Canadian dollar. And those portfolio flows aren't favoring Canada to the same degree. So that all in an environment where the U.S. central banks looks biased to raising rates. Bank of Canada looks biased to easing rates. That's going to continue, we think, to keep the Canadian dollar on the defensive. So around 75 cents, which is where it is today, is probably not a bad guess for where it'll be through the course of the year. For growth prospects, the negative shock from oil prices, the negative is known and it's taking place now, and we see it in very weak investment activity, and that's a trend that will continue as we move forward. So we need some other sectors of the economy to kick in and support growth prospects. Consumer, not quite as big as it is in the U.S., but still a big part of the Canadian economy. So you need the consumer to be growing, and we suspect that'll take place. Fiscal policy, as I suggested, and I'll touch a bit on it later, we will see fiscal policy contributing a bit to growth prospects. The housing sector, we got updated housing numbers today, continued strength in the housing sector, low interest rates, strong job gains, all driving housing. And that's probably going to continue at least through the early part of this year. And then the big driver, the pickup in the growth baton, if you will be from the trade side. More competitive currency, stronger U.S. economy, that should benefit trade, and we're starting to see the export side of the Canadian economy pick up. When you look at exports, a lot of attention on the commodity space. Energy exports, 20% of our exports, non-energy commodities are 30%, and then the non-commodity space is at 50%. So it's that bottom line, that 50% we want to see continue to move higher. As I suggested, competitive currency will help, but the big driver will be U.S. growth, and when you look at the U.S. growth story, it's the U.S. economy where the strength is taking place are those sectors we export to. So it's housing, it's autos, it's equipment and software. So we suspect we'll continue to see exports driving overall growth prospects. The business sector in Canada, when you look at cash, short-term securities, a share of overall GDP, so the cash on balance sheets. Corporate sector is very flush with cash. As the uncertainty eases, that cash gets put to work, and it gets put to work in a number of ways. You get the share buyback, dividend payout, M&A activity, and investment. So we should see some better investment as this uncertainty eases, demand continues to hold up. We'll see more on the investment side, given the strength in the corporate balance sheets. The labor market in Canada, the When you look on a year-over-year basis, just over 125,000 job gains on a year-over-year basis. We've seen a fairly steady gain in employment. Tends to be tilted more to full-time than part-time, tends to be tilted a bit more to private sector than the public sector, but it's contributing to a steady decline in the unemployment rate. More recently, the unemployment rate has ticked slightly higher, so we're at 7.2, but on our long-run basis, we're right around our long-run average. So like the U.S., as the job market's tightened in Canada, we're also starting to see a bit on the wage pressure. It's modest, but we are starting to see wages drift higher, so in and around that 2.5% pace on a year-over-year basis. So it'll help, we think, support consumer spending. When you look at the consumer side, unlike the U.S. or even the U.K., where that debt-to-income ratio has been worked lower, in Canada we're still dealing with this elevated debt-to-income ratio. So the consumer spending in Canada it'll move in line with overall income growth. We won't get that added lift or added kick, if you will, from debt accumulation. So as we look at the debt situation, much of it is housing related. When you look at household debt, about 80% of it's related to the housing sector, mortgage debt in particular. So as long as the housing market remains strong, these debt numbers will remain fairly lofty. As we go forward, firmer prices and a more challenged environment in terms of affordability as interest rates eventually start to tick higher, we'll see that housing number roll over, and with that we should see more moderate debt growth. Fiscal situation, the federal fiscal number, we've got a couple of revisions here. So that 1.9, that was a surplus the Conservatives never achieved. And if you look at more recently in terms of fiscal projections from the Liberal government, we've had 2 rounds of fiscal projections. The first one is that beige line there. The second one, those big 18.5 and 15.5 billion, that's without any new policy initiatives. So that's sort of their marking to market in terms of the fiscal situation. When the campaign commitment heading into the election was 2 years of deficits on the order of $10 billion. That looks like it's gone. A plan towards zero at the end of the mandate, that may well be gone as well. I think they're still holding a zero out there, but the fiscal anchor now has evolved to that debt to GDP ratio, not an ideal anchor. Debt GDP, you have some control over debt, but you have very little control over the GDP. So we see the forecast now is to keep that debt to GDP ratio on a declining trend each and every year. If you back out a 4% growth rate in the nominal economy, that suggests they can run deficits on the order of $25 to $30 billion on a go-forward basis and still meet that debt to GDP ratio declining. We'll get an update, obviously, with the budget on the 22nd, but those $18.5 and $15.5 billion deficits, they look like they're going to be up pushing towards that $25 or $30 billion level as we go forward. Hopefully much of that will be in the infrastructure side rather than overall spending. Infrastructure has been suggested, Minister Matthews suggested as well. With the economy weak, it provides a bit of support. Interest rates low, the cost of borrowing, the cost of meeting those hurdles on those projects are affordable, and they do tend to pay dividends over time. The big challenge is successful fiscal policy has to be timely, targeted, and temporary, and it's getting it timely is the challenge. In Ottawa, they used to talk about shovel-ready projects. Now they're moving towards shovel-worthy projects. So trying to prioritize projects that make sense from an economic perspective rather than how quick they can get the project in the ground. But we will see more growth coming from the support for growth coming from the federal government as we move forward. We have to manage expectations. A $10 billion stimulus package is 0.5 percentage point on GDP. So it's not a huge lift, but it's directionally a positive. For Canadian growth, as I suggest, a little bit higher than consensus. We're at 1.7. I think consensus is at 1.4. And then continued momentum as we move forward into next year. Again, much of this acceleration will have to come from the external side. We're seeing that external side, the export side, starting to pick up. So that should continue to lift overall growth prospects as we move forward. For the Bank of Canada, currently I think they have a bias towards easing rates. We don't think they'll exercise that bias, if you will. So overnight interest rates remaining very low. 50 basis points in the overnight rate. We think at the end of this year will remain at 50 basis points. So a very low interest rate environment. Mortgage rates, market rates should drift higher as growth prospects improve, and we see a little more pressure emanating from the U.S. But a low, slightly rising interest rate environment's the base case for now. When you look at the provincial growth forecast, there's been a reweighting, obviously, and what we're seeing now is those provinces levered to the U.S. economy, competitive currency, moving to the top of the pack, and the provinces obviously more energy intensive are moving down to the bottom of the pack. So that rebalancing is taking place. Ontario, we have second only to British Columbia as we move forward. Then our numbers are slightly higher than what we see in the Ontario budget forecast. When you look at exports from Ontario, so this handoff, if you will, is taking place on a year-over-year basis. Exports in Ontario are up 19%, just off a record that we saw in December, so still very elevated level. 9 of the 11 export sectors are all stronger. It's fairly broadly based. There's only 2 categories actually weighing on overall growth, but it's autos, it's aircraft, it's consumer goods, it's equipment and software. So fairly broad-based gains there, and that's a trend we expect to continue. As I said, U.S. growth, our major trading partners, still 3/4 of our exports go there, and that's all taking place at a more competitive currency. So the export story we're looking at nationally does seem to be taking place provincially. So continued strength in exports. As that holds, we will see more investment and more employment. Minister Matthews mentioned the employment situation. If you look at employment now, we have data on a year-over-year basis. Ontario employment on a year-over-year basis up 100,000. Canada's up 125,000. So Ontario represents 80% of the year-over-year gain in overall Canadian employment. It's all full-time. Of that 100,000, actually 180,000 jobs are full-time, offset by decline in part-time employment. It's very broadly based. 11 of the 16 employment categories are all up, so we're seeing strength broadly based, and it's continued to keep the unemployment rate on a declining trend. So the employment story in Ontario has been very strong, and a trend we expect to continue. When you look at the unemployment rate at 6.7 in Ontario, last year, I think it was 9 of the 12 months, Ontario was below the national average. For the year as a whole, Ontario was below the national average. And that was the first time in 10 years that Ontario's unemployment rate has been below the Canadian average. It's also the first time in 20 years that Ontario's unemployment rate is actually below Alberta's unemployment rate. So you're seeing very strong labor market in Canada and in Ontario in particular. And when you look at the wage side, wages, like the national average, are starting to pick up, but still fairly contained on a year-over-year basis. Wages are running about 3%, which is double the 1.5% we saw in previous years, but still not terribly robust. When you look at the migration numbers, population growth in Canada is just over 1%. In Ontario, it's just under 2%. What we're seeing is very strong international migration flows. That's a trend that we expect to continue. But we're also starting to see some changing dynamics on the interprovincial basis. So interprovincial migration flows, the number of people that come to the province relative to those that leave the province for other provinces. And that actually moved into a small positive in the third quarter of last year. So when you look at interprovincial migration flows, one of the key drivers is the relative unemployment rates in the provinces. So it's kind of a push and a pull. If the job market's strong, there's a bit of a pull. In other provinces, if the job market's weak, there's a bit of a push. So you're starting to see that rebalancing. We're starting to see interprovincial migration flows favoring Ontario relative to some of the other provinces, in particular Alberta. And that's going to continue to support the overall population growth, as I said, very strong in the province. And that will provide support for consumer and, importantly, the housing market. We travel around, people always talk about the Canadian housing market, when it's going to crash. There is no Canadian housing market. There's a bunch of regional markets. And if you look across Canada, there's a couple regions that are very strong, British Columbia and Ontario. If you look within those provinces, there's a couple cities very strong, Vancouver and Toronto. And then if you look within Toronto and Vancouver, it's really taking place in the detached homes relative to multifamily homes. So the demand is for detached homes. We aren't building enough of the detached homes, so that those price pressures remain fairly elevated. And that's continued for some period of time. If you look at the inventory to sales to listings, a bunch of the indicators more broadly, there is a large stock of homes coming onto the market in the multifamily to condo space, but to date absorption has not been an issue. We expect that to trend to continue, but we are starting to see prices very firm on a year-over-year basis. We're starting, we think, to see rates moving higher this year. So housing affordability a bit more of a challenge. The housing market would probably cool in that environment. So this year, housing starts very similar to last year, but through the year, we expect to drift to slightly lower levels, but still fairly buoyant housing sector overall. The fiscal situation, Minister Matthews spoke to, here's the graphs behind the data. So we have seen a fiscal situation. We are on the path towards balance. That's the deficit. One has to also look at the debt. And if you look at the debt over the last 10 years, the debt in the province has doubled, so just over $300 billion in debt. The peak in that debt to GDP ratio is now forecast to be just shy of 40%. So we're still seeing a very elevated level of debt to GDP relative to all the other provinces. We're second only to Quebec. So a very elevated level of debt, notwithstanding the fact that we're moving back to balance on the fiscal front. So as we go forward, we will see this balance, but as I suggested, the debt situation continues to be arguably more of a story as we go forward. That's how you can square these balanced budgets with these large infrastructure spending. To the extent it is infrastructure, we will see eventual dividends for that. So short term, it supports growth. Long term, it also provides a lift and eventually pays some dividends. In terms of the Ontario story, as I suggested, we are looking at this handoff. It has to be an export-led recovery. When you look across Canada, the province most levered to strong U.S. and a more competitive currency is Ontario. So we should see Ontario continue to lead the Canadian average as we move forward in this fairly uncertain time. That's our website. All our publications are on there. Most of what I said is on there, and the rest of it I made up. So Sean, I think we have some time. So thank you for your attention. I think we have some time for questions.